This is how to make profits with 7 DTE credit spreads. And my name is Alisada. I will be talking through this portion of 7 DTE credit spreads, and I trade them pretty much daily. And towards the end of the session today, I'll be talking about how to break those barriers that lead to consistently profitable results. And so stay with me to the end, and we're going to have a great session here. All right, so let's get started. All right, so first of all, what can you expect? I'm going to show you how to make consistent returns monthly based on margin capital at risk and using SPX 7 DTE high probability trades. And these are without taking large losses and make those returns month over month. And that's really the goal here. Okay, so what will you learn? First of all, how to select the right strike prices, number one. Number two, how to take detailed entry and exit stop loss criteria to maintain consistency. That's really, really important. How to prevent large losses by managing threatened trades. How to know when to trade. That's really important. The best time to widen spreads and to gain an edge on a position. And then finally, how to trade consistently profitable, right? And that's really the goal here. The most important thing is having a great mindset when you're trading. So imagine first what it would feel like if your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. Secondly, becoming the trader that no longer takes large losses, but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month. That's really the goal here. And first of all, you really need to ensure that your state of mind is extremely good. And so that way you're always going to be in the know and be positive when you're trading. Okay, it's just really, really important. All right. So first of all, let's talk about the SPX credit spread and what is it? A credit spread is a combination of two puts and two calls where the put or call that is sold is more expensive than the put or call that is bought, right? That's why you receive a credit when you place a trade. So here, in this case, we're selling one contract, 29 August 22, and you're selling the 40.50 and buying the 40.40 put. And that gives you a credit of 50 cents times 100, which is $50. So that's really the initiation of a spread, of a credit spread. And then selling the 40.50 and buying the 40.40 put. And this trade is considered to be a high probability trade. All right, and we'll talk about why it's a high probability trade as we go through these sections here, okay? So number one, if you look at the SPX options rate of decay, and this is a call spread, from 68 days to 33 days, the rate of decay is 34%. From 33 days to 5 days, the rate of decay is 57%. And from 5 days to expiration, the rate of decay is 100%. So we're looking at the back half of this, from 5 days or 7 days to expiration. That decay really, really happens very, very quickly. So let's talk about all the profitability factors, and there's three. So number one is implied volatility. So when you put on a credit spread, a 7 DTE credit spread, you want to place that trade when the volatility is the highest, okay? And we'll talk about that in a few minutes. And when you place that trade, you want to put it on, and then hopefully after that, the volatility reduces and it gives you a profit much, much quicker. And that's really the ideal goal, but sometimes it doesn't happen that way. But that's really what you're shooting for. All right, number two is Theta. Theta is one of the Greeks that measures the rate of decline in the value of an option due to the passage of time. So it's important to understand that you want to put it on when the trade is of highest volatility, and then after that trade, it goes down and the volatility goes down. The best time to do that is really at the open of the regular session of trading. That's where the highest volatility is, and we use that for 0 DTE as well. So that's the second profitability factor. The third is market direction. So a trending market away from your position will cause a premium to drop, and if you enter the trade and the market moves against you, the direction of the credit spread, you'll see the premium increase significantly, okay? So again, the goal is to place these trades so that you get the market direction right, the volatility right, and that's really the ideal thing, right? But it doesn't always happen. But still, it's these trades are very, very forgiving unless it really goes against you hard. All right, and we'll talk about that. Okay, so let's talk about the risk management and guidelines. This is really, really important. So number one, always trade with a plan. You always want to have a trade plan that's made for you and you're accustomed to, okay? And you want to stick to it and be disciplined on these plans. Determine the max loss and risk reward before entering trade. We'll look at the risk reward on this in a few minutes. Trade no more than 20% of the credit margin at risk, and always save enough margin to be able to manage the trades if they go against you, okay? So that's really, really important. And don't allow any more than a 2% loss based on your trading capital. And that means that you want to make sure that if you are trading these types of positions, that it doesn't go against you really, really hard, and then you are able to manage these by adjusting them in different ways. We'll talk more about that in a minute. Okay, for highly trending markets, position your trades to follow the trend, right? That makes sense. And again, it doesn't always happen, but if you look at the technicals, you can see where the market's going most of the time, and then place those trades based on that trend. All right, size your trades to ensure emotions are not part of the decision-making process. So especially if you have a smaller account, you want to make sure that you're not trading big based on your account size, because what happens is the emotional state of you will make decisions not based on your trade plan, but based on emotions. And that's what you don't want to do. All right, so let's go to pre-market routine. Review areas of support and resistance. And, I have different videos to show how to do that. And actually, we're going to be doing another webinar about MNQ and ES options. And those are really, really important because you want to get that direction right. So always look at where your support and resistance areas are, and it helps you with your trading. Number two is review the dollar. Typically, when the dollar goes up, markets go down. And then the opposite is the same. And at this time, basically, the dollar is moving up and it's putting pressure on the SPX. And that's very, very normal. 10-year treasuries are always the same as well regarding the dollar. So when treasuries move up or treasury rates move up, it does put pressure on the SPX, and you want to be cognizant of that as well. Review ES futures trending direction. So ES futures is a derivative of the SPX, but it trades basically almost 7 days, but it's always trading Sunday through Friday, and it's closed on Saturday, and then it opens up on Sunday night. When you're looking at that, the SPX will have gaps, but ES never have gaps except for the weekend. And then it's a great way to understand where the trend is and how it's going. All right. And then the VIX is important as well, because the VIX is the volatility index for the SPX. Even though it's based on a monthly action, it's still a very, very good tool to understand where the market is in terms of volatility, right? And then determine when you place your credit spreads, you want to save them and then be ready to trade them immediately when the market opens. And that's what I do. Okay, so the risk reward, as I mentioned before, it's very, very bad. So if you place trades, and you'll understand. So the risk reward here, if you take a 10 vertical and you place a 65 position, then the risk reward is basically 10,000 to 650. So it's really, really bad. However, if you're a credit spread trader, you know this, and you know how to manage these trades when it goes against you. The good part is that even though, yeah, it is a max loss if you do that, if you allow that, but if you manage it correctly, the trades will be, you'll get a 80, 90% return rate by trading these trades, and it's very, very profitable. If you manage them correctly. That's what we're going to do here today to make sure that you're learning how to do this and position these trades correctly. So let's go through the entry and exit guidelines. When I enter a trade, as I mentioned before, I like to enter a trade when the normal session opens at 9:30 Eastern time. That's really the highest volatility. Okay, so when you place I like placing 7 DTE trades at that time, especially if you think the market is going to be going up. Okay, and usually the market most of the time goes up, but there are times that it doesn't. Okay, but you're working with probabilities, and that's really the highest probability. I like to use a 10 delta to 12 delta for 7 DTE, and the premium on that is about 75 to 90 cents. That's really where your target should be, okay, when you're placing these trades. And again, if you place them when it's highest volatility, you'll see the change in that premium go very, very quickly and decay because of that volatility. Wider spreads provide greater distance to the market, basically less risk. However, price can require additional margin, and that actually increases risk. Okay, so it's kind of a trade-off. And we'll be talking about how that works when you're positioning your trades. All right, so take profit. I generally, when I place a trade, once the trade is executed, I will place a closing trade for 10 cents, and it's just automatic for me. And most of the time we get that filled. And sometimes I even go less to 5 cents when the market is really going against the credit spread in the right way, basically. And that position sometimes goes, it'll when the market is already moving down, let's say, or moving up rather, you'll get a nice fill and be able to close that trade immediately when the market opens. So expiration is another way to close the trade. I don't generally allow it to go into expiration unless I'm doing 0 DTE. In any case, that's just another way to close that trade. You don't want to make a profitable trade turn into a non-profitable trade. So once you have a profit, you want to watch it and make sure you're able to close it with a profit. All right, so let's talk a little bit about exit, adjustment, or roll. So I roll bull spreads within 30 to 40 points of a threatened short strike. So you don't want to let it go into the money. And then you want to widen some spreads at times when the market is going against you. We'll go through that, and it gives you greater distance from the market. And again, I'm going to be able to share all the questions, take all the questions that you have. So hang in there. All right, stop losses. Stop losses are I seldom use stop losses, except in the case of like bear spreads when the market is moving up really fast against you. And so after about 3 or 4 adjustments, you might want to just cut your losses and move on. Okay, especially on a bear spread. On bull spreads, they're much easier to manage just because when the market's moving down, there's high volatility, and it is much easier to manage trades when they're that way. Okay, so I'm going to share with you these trades here that were just recently placed. All right, so on July 27th, we placed a call spread and a bull spread. And so that's an iron condor. And we received 65 cents for the call spread, and we received 80 cents for the put spread. And then so the premium at that point was $1.45 that we received. Then what happened? July 28th, what happened was that we closed the trade because the market went up. And so we closed that trade and then placed the call spread again, and we received 65 cents. So now the premium is $1.20. All right, so July 31st, we opened a new trade, a put spread, and collected 70 cents. And so now we have trade 564 that was placed on 727, and the 566 trade was placed on 731. Okay, so now we have an iron condor here again, and the premium now is $1.90. So August 2nd, we had to close the trade. Now the market moved lower, and so the call spread was 5 cents, and then we rolled the put spread down, and so we went from 45.20 to 44.85, 44.70. What that did was that we widened the spread, okay, so that it would go down further, and we got 0 credit for that. But what happened was that we were de-risking the trade, so we reduced it further down. And then we placed another trade and collected 90 cents for this trade. So now, all in all, we have now 2 trades. It's an iron condor. We have 45.85, 45.70 with a 70 cent premium. and we have 46.45, 46.65 with a 90-cent premium. And so what I do on these trades, we widen them and place a new trade. I'll place the same margin for that trade in order to keep it symmetrical and widened sufficiently. And that actually gives you a better risk reward on the trade. So now we have a premium of 275. So now, August 3rd, the market moved. And so we were able to close this trade because the opposite side was being threatened. So we closed this trade first, and then we added a call spread to the position. And now we have the two positions here on another iron condor. If you look at the -1, that means that we rolled that position one time. And so now we have 44.85, 44.70, and then the call side, we have 46.10, 46.25, and we receive that credit there of 80 cents. So now our premium is $3.35. So now you can see here this big dive down, okay? August 4th. So August 4th, the market went up and then it went down very quickly. And so we had to adjust the trade. And so at this time, I saw that the trade was being threatened. So I said, okay, let's close this trade at 25 cents. So we got a profit on it. And then we opened a trade. We went from 45.85 to 44.70. And then we opened the trade for 46.60, 46.40. And basically it was a debit of 5 cents. And so my goal was to get the trade as furthest away from the money as possible so that we can manage it and still retain profitability. All right, so here now we have the 566 trade and the 574 trade, which is new, and we have another credit that we received. So now our premium is at $3.05. Now on August 9th. August 9th, again, the market went down. And so we closed the call spread for 15 cents. So we rolled the trade down and we actually collected 10 cents on that trade. So we went from 40.60 on the short strike to 40.45 on the short strike that the trade was adjusted. So now we have, again, you can see here 3. So we rolled this trade 3 times. And now we have another credit that we added, and now we have a $3 premium. So now, August 11th. August 11th, again, the market went down. So we closed this trade at 10 cents, and then we added an additional call spread for 75 cents. And now we have the 40.45, 45.20, and the 45.35, 45.55 call spread, okay? And this is where the market is just continually going down. So now we have a premium of 365. So that's really where we're at this point. And actually we had to roll the trade today because the market continued to go down, okay? So that's really the process of managing these trades. And eventually what happens is the market, it doesn't go down forever, but we've gone down about 3%, but we eventually get out of those trades, and we do this over and over again. So this is really the process for how to maintain profitability when you have those trades. And it looks like today we may get a little rebound here so we can push and get out of these trades. And if not, we roll them again. So that's really the process that I use for 7DTE, and it's been evolving over time. But let me share here the performance of these trades. And so for 0DTE, the July performance and year to date is 8,958, and we had a $893 profit, and this includes commissions and fees. All right. 7DTE year to date is 2,154 for July, and year to date is 11,400. And I'm using 2 contracts to place these trades, and it works really, really well. And I do that because I don't want to use a lot of margin in case we have to roll these trades like I did, and that way you stick with your profitability standards, and the positions do pretty well over time. We do options on futures as well. The The monthly is 1614, 2644 year to date. And the reason we don't have a lot of profit on that is because the market went up very, very quickly towards the beginning of the year, and we had to roll those positions up to make them profitable. And now actually things are working out pretty well. Okay, so options on futures, these are trades that we use overnight because we don't like to use SPX trades because there's overnight risk on that trade because you can't close those trades overnight. So we use options on futures, trading overnight. I actually have a position today that I placed, and I pretty much place those positions almost every day. That's the performance on those trades as well. And then we have a couple of others. We have futures trades and we have premium trades. One of our traders, Ike, trades naked options, puts and calls, basically buying and puts and calls. And those are very, very simple trades. So this works, as you can see, and hopefully you have a good understanding of how these trades work now. Okay.